There is a famous moment from a 2011 interview where Warren Buffett mentioned that he pays a lower effective tax rate than his secretary. His secretary, the person answering his calls and managing his calendar. She pays a higher percentage of her income to the federal government than one of the wealthiest humans on earth. And when that story broke, there was the predictable cycle of outrage, congressional hearings, proposals for a Buffett rule, and then absolutely nothing changed. Because what Buffett described is not a glitch in the tax code. It is not an oversight or an unintended consequence. It is the intended lobbied for legislatively protected outcome of a system that has been carefully engineered over decades to ensure that wealth, once accumulated beyond a certain threshold, compounds largely free from the taxes that apply to everyone else. And by the end of this video, you are going to understand not just that this is happening, but precisely how the mechanism works, what it is called, who designed it, and why it has survived every reform attempt for the last 40 years. Let's start with the foundational illusion, which is that the American tax system is progressive. On paper it is. The federal income tax has 7 brackets. The lowest rate is 10%. The highest is 37%. The more you earn, the higher your rate. That structure implies that the wealthiest Americans pay the highest percentage of their income in taxes. And for people whose wealth comes primarily from a salary, that is roughly true. But here's the thing about truly wealthy people. They do not have salaries, not in the way you do. Their wealth does not show up as income on a W-2. It shows up as appreciating assets, rising stock prices, growing real estate portfolios, expanding business ownership stakes. And under the American tax code, assets that increase in value are not taxed until they are sold. This is called the unrealized gains exemption, and it is the cornerstone of how extreme wealth avoids extreme taxation. Let's make this concrete. Meet Robert. Robert founded a tech company in his 30s. He owned shares worth $4 billion. Last year, those shares increased in value by $400 million. Robert's wealth grew by $400 million in a single year. His federal income tax bill on that growth, $0, because he did not sell the shares. He did not realize the gain. Under current law, no taxable income occurred. Meanwhile, Robert's head of marketing earns $220,000 per year. She pays federal income tax on every dollar of that salary. Her effective federal rate is somewhere around 32%. Robert's effective rate on his $400 million wealth increase, 0%. This is not aggressive tax planning. This is the default outcome of the basic rules, and it gets more structured from there, because Robert does not just sit on his shares. He needs money to live, so he borrows against them. Banks will lend billionaires money collateralized by their stock portfolios at interest rates, sometimes below 2%. Robert takes a $50 million loan against his shares. He lives on that loan. The loan is not income. Loans are not taxable. He pays the interest, which may itself be deductible. His lifestyle is funded. His shares keep appreciating. His tax bill remains negligible. This strategy is so common among the ultra wealthy it has acquired a nickname among tax lawyers. Buy, borrow, die. Borrow against them to fund your life tax. Free. Die holding the assets, at which point your heirs receive them at a stepped-up basis, meaning the accumulated gain is permanently wiped from the tax record. If Robert holds his $4 billion portfolio until death and leaves it to his children, his heirs receive the shares with a cost basis reset to the value at his date of death. The 40 years of appreciation that built that fortune, the hundreds of millions or billions in gains that were never taxed, are permanently erased from the taxable record. Nobody ever pays tax on that wealth. The gain is not deferred. It is not exempted. It is extinguished. And this is not a loophole that slipped through by accident. Stepped-up basis has been in the tax code since 1921. It has survived every tax reform since then, because the people who benefit from it are also the people with the resources to ensure it survives. No, let's add one more layer, because the architecture gets more intricate. Carried interest. If you work in private equity or hedge funds, your primary compensation is typically structured as carried interest, a share of the profits generated by the fund you manage. Economically, carried interest is compensation. You are being paid for your work managing capital. Under any intuitive definition, it is income. Under the tax code, it is classified as long-term capital gains, which means it is taxed at a maximum rate of 20% rather than the 37% ordinary income rate that applies to a doctor, a software engineer, or anyone else who earns comparable compensation for their professional work. A PA fund manager who earns $50 million in carried interest pays a maximum federal rate of 20%, plus the 3.8% net investment income tax. A hospital administrator earning $500,000 pays a top rate of 37%. The person managing billions in financial capital pays a lower rate than the person managing a hospital department. And when Congress has proposed reclassifying carried interest as ordinary income, which every independent tax economist agrees is the correct classification, the private equity lobby has spent tens of millions of dollars ensuring the proposal dies. It has died in 2007, 2010, 2017, and 2021. Each time, it has been amended, watered down, delayed, or quietly removed from final legislation. The industry is not subtle about the investment thesis here. Spending $30 million on lobbying to protect a tax treatment that saves the industry billions annually is not charity. It is arithmetic. Now, let's talk about who enforces this code. Because enforcement is where the system becomes openly absurd. The IRS audits tax returns. But it does not audit all returns equally. A 2022 investigation by ProPublica and academic researchers found that the audit rate for the lowest income Americans, those claiming the earned income tax credit, was higher than the audit rate for taxpayers earning between $200,000 and $500,000. The poor were audited more frequently than the upper middle class. The reason is not malice. It is budget constraints and audit economics. An ITC audit is relatively simple. The return is straightforward. The IRS can conduct it by mail. It does not require specialized agents. A billionaire's tax return involves dozens of entities, complex financial instruments, international structures, and years of documentation. Auditing it requires senior agents with specialized expertise, and the IRS has been systematically defunded for years. Between 2010 and 2022, the IRS lost roughly 30% of its workforce. The number of revenue agents capable of auditing complex returns fell by nearly 40%. The audit rate for taxpayers earning over $1 million fell from nearly 8% in 2011 to under 0.7% in 2019. An audit has become, for the truly wealthy, a statistical near impossibility, and complexity, which the wealthy can afford and the IRS cannot keep up with, is itself a weapon. The American tax code is approximately 70,000 pages long. No human being understands all of it. The complexity does not exist because taxation is inherently complex. It exists because every carve-out, every exception, every special treatment added over decades of lobbying has to be defined, scoped, and cross-referenced. The complexity is the accumulated legislative output of every industry that successfully argued it deserved special treatment. And it functions as a moat. The wealthy can hire teams of accountants and lawyers to navigate and exploit the complexity. Everyone else either uses basic software that cannot see the sophisticated strategies, or pays practitioners whose expertise stops well short of the planning available to clients with 10 or 100 times their net worth. Now, here is the historical rhyme that should make you uncomfortable, because this is not the first time American wealth concentration has coincided with a tax structure that protected it. In the Gilded Age of the late 1800s and early 1900s, there was no federal income tax at all. The Rockefellers, Carnegies, and Vanderbilts accumulated fortunes that in today's terms would dwarf even the wealthiest people alive now. The public backlash eventually produced the 16th Amendment in 1913, establishing the federal income tax, followed by steeply progressive rates that by the 1950s saw the top marginal rate reach 91%. Those rates were imperfect and riddled with deductions. But the era of very high top rates, from the 1940s through the 1970s, coincided with the period of the greatest compression of inequality in American history. The middle class expanded, wages grew broadly. Then came the 1980s, and the top marginal rate fell from 70 to 28% in less than a decade. Capital gains rates were cut repeatedly. The carried interest treatment was preserved. Stepped-up basis survived every reform attempt. And over the 40 years since, wealth has concentrated back toward Gilded Age levels. The top 1% now holds approximately 32% of all American wealth. The bottom 50% holds approximately 2.6%. The tax code did not cause this entirely, but it accelerated and protected it. Because a tax system that taxes work more heavily than wealth, that audits the poor more frequently than the rich, that allows generational transfers of fortunes with no tax on the accumulated gains, and that is complex enough to be navigable only by those with resources to pay for guidance, is a system that functions as a wealth preservation machine for those already inside it and a barrier to entry for everyone trying to get there. So what do you do with this information? Because the natural response to learning the game is rigged is either outrage or resignation, and neither of those pays your taxes. First, understand that the strategies available to the ultra-wealthy have diluted versions available to ordinary people. Tax-advantaged accounts, 401ks, IRAs, HSAs, are a scaled-down version of the same logic. Defer or eliminate taxation on growth. If you are not maximizing these, you are paying taxes on gains that the rules allow you to defer. Use the tools that exist. Second, if you own a business or have significant assets, understand that the distinction between ordinary income and capital gains is one of the most powerful levers in the personal tax code. How you structure the sale of a business, how you time capital gains, whether you hold assets until death or transfer them during life, can produce tax outcomes that vary by hundreds of thousands of dollars for decisions that look superficially similar. This is not aggressive tax planning. It is knowing the rules of the game you are playing. Third, when tax reform proposals come up, pay attention to the specific mechanisms, not the general arguments about fairness, which are real but abstract, but the specific provisions carried interest reclassification, unrealized gains taxation above a threshold, stepped-up basis reform, minimum billionaire tax proposals. Each of these targets a specific mechanism in the system. The intensity of lobbying opposition to each of these proposals is roughly proportional to the amount of money the provision would collect. That is a useful calibration tool. And finally, understand that the tax code is not a natural phenomenon. It is not a mathematical truth. It is legislation. It was written by people responding to incentives. It can be rewritten. It has been rewritten before. The question is whether the political will to do so can be assembled faster than the lobbying infrastructure that has protected the current structure for 4 decades. History suggests that gap only closes when the wealth concentration it enables becomes visible and painful enough to produce a political constituency for reform larger than the financial constituency for preservation. We may be approaching that threshold, or we may not be. So I want to hear where you land. Do you think the current tax treatment of wealth versus income is a fundamentally fair, a rational system that rewards risk, taking and capital formation, and reform proposals would damage investment and growth? Be a structurally corrupt arrangement that taxes work more heavily than wealth and should be overhauled starting with carried interest, stepped-up basis, and unrealized gains above a threshold, or C broken in specific ways that are fixable without dismantling the system. And the real problem is enforcement capacity and lobbying influence rather than the underlying structure of the code. Drop your take in the comments because the disagreements on this one are genuine, the numbers are real, and the stakes are larger than any single election cycle tends to acknowledge. And the next time someone tells you the tax code is too complicated to understand, remember that the complexity is not an accident. It is a feature, and it was installed by people who could afford to pay for it.